In this week's video, we'll be tackling this topic from a different angle, the most important thing in investing and trading. The purpose of this video is to highlight the dangers of placing too much emphasis on short-term moves in the market. If we do that, that means we're most likely making decisions based upon our emotions, which is not a good plan from a probability perspective. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We'll start with a few basic questions. How concerned would we be carrying an above-average cash balance during these sharp rallies? These are actual daily charts from the S&P 500. This is a rally of over 10% that took place over 8 calendar days. We're all human. If you were in 50% stocks and 50% cash here, or worse, short or 100% cash, it wouldn't feel very good when the market moves 10% in 8 calendar days. In a similar manner, this is an 8.5% move that took place over 14 calendar days. Examining the other end of the spectrum, how would we feel if we were fully invested in stocks during a 17% sell-off? The answer is obvious. We wouldn't feel very good. How can these two questions help us in the present day and help us better understand the most important concept in investing and trading? You might be surprised to learn that our examples occurred at the same time, basically. This is the flash crash from 2010. If we managed based upon emotions here and we bought basically due to the fear of missing out or due to greed, this 10% move was quickly retraced. In a similar vein, if we bought based upon greed or the fear of missing out rather than a rational system in an unbiased manner in terms of evaluation, if we bought here, the 8% gain would have been quickly retraced. So the most important thing in investing and trading is discerning the primary trend on your time frame, and better yet, to discern trends on multiple time frames and use them to make decisions. The trend here was clearly down. These are counter-trend rallies that we refer to as volatility to ignore. Why? The trend is still down. Volatility to ignore. Why? The overall trend is still down. And it's not that binary. It's not volatility to ignore. You want to make sure that if you do scale in, that you're scaling in at a rate that also takes into account the longer-term trend here, and you need to see enough improvement and let this trend start to reverse before we put more of our capital at risk. The point of the exercise is we cannot expect to be perfectly allocated for each trading day or even each trading week. Let's look at another example. Same exact concepts. How concerned would we be if we were carrying an above-average cash position, or if we had a mixture of stocks and bonds or stocks and currencies during these periods? 5 days, 8% gain. 12 calendar days, almost a 10% gain. 63 calendar days, a 14% gain. 27 calendar days, over a 9% gain. 25 calendar days, almost a 20% pop. 27% pop over 46 calendar days, and an 8.79% pop over 9 days. Shifting back to the other end of the spectrum, we really don't even have to ask this. We know what the answer is. None of us would feel good if we stayed fully invested in stocks and lost almost 58%, as is what happened in this actual example from the S&P 500. The point of the exercise is to illustrate that the same concepts apply to longer time frames, which is another example of market fractals. So all of these examples apply if you trade 10-minute charts, 60-minute charts, daily charts, weekly charts, monthly charts. The concepts are all the same. Our job is to discern between volatility to ignore, volatility to ignore, volatility to ignore, and eventually volatility to respect in this direction, because now the moves have hit a point where it makes sense to allocate a larger percentage of our capital. What the market model does, and again, it's not binary. It's not stay out of the stock market, stay out of the stock market, stay out of the stock market. What you have to do is offset this rally with the longer term evidence, which is still weak here. And our job is to discern what is a rational mix between risk assets, such as stocks, and conservative assets, such as bonds, cash, or currencies, at this point. What is a rational mix at this point? Looking at these charts, we can understand how people lose 58% in a bear market. Why? The market has counter-trend rallies that gives them hope. Gives them hope. They might be thinking of selling out right here. Then we get a 20% rally. It gives them hope. Then it declines again. So our job is to discern what the primary trend is and allocate accordingly. We can allocate to stocks here, but we can't allocate to a high percentage. Why? I'm going to show you how to find 3 historical examples. One is the flash crash that we just showed, and one is this period here in 2008. If you go to our website, www.shabakacapital.com, look in the left margin and click on FAQ. Then you want to scroll down to number 8. Can probabilistic models handle harder cases such as 1987, 2008, and the 2010 flash crash? To understand how we monitor and allocate based upon observable evidence, you can use these links here. This shows you a video for the financial crisis. This link will take you to a video about the 2010 flash crash, and the first one, Black Monday, the 1987 crash, to cover those concepts. Just to drive home the point of why we have to discern between volatility to ignore and volatility to respect, and primary trends and counter trends. If we bought here based upon emotions, the entire gain was wiped out. Bought here based upon emotions, wiped out, wiped out, wiped out. 20% gain, erased. 27% gain, fully erased. 8% gain, erased. This is where you get yourself on a schizophrenic roller coaster where you feel like you're missing out and then you're disappointed. Feel like you're missing out, then you're disappointed. That's why systems help. We want to remove our human emotions from the process, and we want to look at this market as if we're looking at it from outside. Take our emotions out of the equation and make rational decisions based on facts and primary trends. Fast forwarding back to the present day, this is a chart as of Thursday, October 2nd. You can see here we had a bounce back rally. The point of the exercise here now is, have we seen something that's past the stage of volatility to ignore? This is a short-term downtrend. It is normal for a downtrend to experience counter-trend rallies within the context of an ongoing downtrend that match with Fibonacci numbers, a 38.5 0.2% retracement of this loss would take us to 1962. A 50% retracement of this loss would take us to roughly 1973, and a 61.8% retracement to just a hair under 1984. We closed under both of these levels on Friday. We did surpass this one. However, we did not clear these downward sloping trend lines here. So this is still volatility to ignore within the context of this daily downtrend. We'd prefer to see price clear both of these pink trend lines, recapture the 50-day at 1975-ish. We'd like to see price move away significantly from the 50-day, and we'd like to see the slope of the 50-day turn back up. During the day on Friday, we asked, when the market was up 15 points, does this look like a short-term downtrend or uptrend? The answer is easy. It's still a downtrend. The purpose here is not to criticize anyone that bought this week. If you're a short-term trader and you bought here, good for you. The timing of when you enter is highly dependent upon your time frame. We have longer time frames because we're investors instead of traders. So we want to be more patient and see that we've at least cleared volatility to ignore here. We'll move to some other charts now on longer term time frames that clearly illustrate another reason why we're trying to be patient with our cash. The historical charts that we looked at earlier were daily charts. We use daily, weekly, monthly, and 60-minute charts to make buy decisions. Why? They're all helpful. None of them are perfect. We use these moving averages to help us discern between a longer-term downtrend, volatility to ignore, and an uptrend, volatility to ignore. The bullish trend is still intact, volatility to ignore. This is the S&P 500 in 2008. This is a low probability look. This is the S&P 500 in 2009. This is a high probability look. This is the S&P 500 using the same moving averages, weekly, 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 as of the close on Friday, October 3rd. Does this look more like this favorable period or this unfavorable period? The answer is easy. It looks more like this. How do we use it? We want to see observable evidence that the trend has improved. We want this to morph into a look more like this. If it does, it will check bullish boxes, and the rules will force us to start scaling back in if the evidence can improve. The objective here is not to say it won't improve. We just need to see it. Same exact concepts. We like to use common sense. That makes sense to me. Risk on, risk off ratios. This is stocks relative to the aggregate bond ETF AGG. Think of this as a diversified basket of fixed income securities. When people are fearful, the demand for AGG is greater than the demand for growth-oriented equities, and hence the ratio falls and takes on a full-bore bearish look. It's just the opposite when they're confident. This says I'd prefer to own stocks relative to bonds. This still has a full-bore bearish look as of the close on Friday, October 3rd. Same concepts, more charts used by the market model. Weekly NASDAQ as of the close on Friday, October 3rd. Still has a full-bore bearish look. This still looks more like this low probability period in 2002 than this high probability period in 2003. This doesn't tell us what will happen next. We just want to see this morph into a look like this, and then we can start scaling back in with some of our cash. Is it all gloom and doom? No. If you're a client, you know the answer is no, because we still have some exposure to stocks telling us that some of the things that we follow are still positive. The Dow, for example, as of the close on Friday, October 3rd, has not had a bearish moving average crossover yet, so it's a little bit more mixed. So we'll keep an open mind about what happens next and allocate accordingly. If you're relatively new to the fold, you might say these guys are Perma Bears. No, we're not. We're just waiting for the evidence to tell us that it's rational for us to allocate more capital back to stocks to add to our existing stock positions. We did so here on May 23rd. Here's a tweet from May 23rd. We need to see something similar, and we're happy to take action. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currency, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.